live stream. Now, clearly what everyone's thinking about tonight is the sell-off which we've been seeing in markets. And so I will talk about that, and I will talk about what we've seen, the reasons behind it, and how we should react to it, which is not easy. And I think that's actually the most difficult part. And then obviously I'll throw it open to questions and we can talk for an hour together and then we'll wrap it up. So that's the plan. And yeah, I think maybe the place to start then is with the sell-off. Now, yesterday was, as Trump called it, Liberation Day, and we found out exactly the scale of the tariffs, which I think surprised a lot of people in terms of their scope. The idea is that there are reciprocal tariffs, so the Trump administration came up with its perceived tariff for each country, and then it roughly halved the tariff that it perceives as being there. I say perceive because it is a subjective thing. For example, do you include value-added tax in the country you're exporting to? Most economists would say that's ridiculous because value-added tax applies to imports and it applies to domestically produced goods. So it's not as if VAT charged in the UK favours domestically produced stuff versus imported stuff from the US, but that's the way the administration's chosen to do it. The UK, it has to be said, came out on the lowest tier, which was 10%, the minimum, and obviously there are going to be negotiations based on this set of tariffs. So really, I think markets were shocked by the scope of the tariffs, the breadth of the tariffs, and generally the asset response has been a huge sell-off in risk. Not catastrophic by any means, but certainly a substantial sell-off. So let's have a quick look through the different asset types just to kind of illustrate that. So let's look at the charts. So let's start off with, let's go for asset classes. Yeah. So let's start off with the Nasdaq index. So you can see the point at which Trump, at least this is the end of day stuff. So based on yesterday's close, the Nasdaq QQQ, which is the Nasdaq 100 tracker from Invesco, that was down 4.5% over the course of a day. So a fairly brutal sell-off. And if we look at the S&P, so SPY, SPY is the big ETF which tracks the S&P. That was down 3.9%. So again, risky asset sells off. And let's look at a government bond ETF. So this is TLT, which tracks long duration US Treasuries. These are US Treasuries with a maturity of 20 years or more. You can see that that rallied very significantly. So bonds worked in this case as a hedge because it is a fear response that we saw from markets. A risk-off move generally favours treasuries because people, when they're scared, buy US treasuries. So at least at the moment, we're not talking about really awful things, which is US treasuries selling off as well. However, one thing that was kind of surprising is, well, no surprises with Bitcoin because it's a risky asset. It behaves very much as levered Nasdaq. In fact, why don't we just have a quick look at that one because it's always interesting. So this is, oh no, it's not. So this is, ignore the code on the left hand side. I'll make this a bit bigger. So what I've done here is I've looked at the daily return of the Nasdaq 100 index, multiplied that daily return by 3, and then worked out a cumulative return for 3 times daily Nasdaq. And you can buy ETFs that do this. But the red line is Bitcoin, and the yellow line is 3 times daily levered Nasdaq. And you can see the two track each other pretty closely. The sell-off in Nasdaq, 3 times levered Nasdaq, the yellow line, has been bigger than the sell-off in Bitcoin. But notice how the two track one another very closely, even down to the kind of little relief rally that we saw and then the sell-off that followed. So Yeah, I think the kind of claim that Bitcoin's some kind of store of value is just nonsense. It's behaving very much like 3 times levered Nasdaq. Um, yeah, I think the more surprising thing was actually to do with the dollar. Now, normally, what happens if people are scared, they'll buy US dollars and the dollar will rally. But let's look at what happened to the dollar this time around. FX majors. Here we go. Share. There we go. So this is the value of sterling versus the dollar. So if this number goes up, it means the dollar's weakening. So you can see the point at which Trump started speaking. So if we go from the point before he started speaking to the weakest point today, there's a 1.9% sell-off in the US dollar. Now, over a 1 day, for a 1 day move, that is absolutely huge. A huge devaluing of the dollar over the course of a day. If we zoom out, you'll see the scale of the sell-off. Let me zoom in a little bit. Yeah, so this is the sell-off that we saw just over the course of 1 day recently. And it's kind of shocking because let's look at the euro. Okay, so euro versus the dollar, similar story. Very sharp sell-off and a weakening of the dollar. So that, I think, is probably more scary than some of the equity market sell-offs, which, although large, are not huge. I think the sell-off of the dollar, when people are scared, is particularly worrying because it's not acting like a safe haven currency, the US dollar. And that is that is shocking and shockingly bad and shockingly scary. At least Treasuries held up. If Treasuries had sold off as well, then we'd be talking about some really scary stuff. But I think just the fact that dollars sold off is pretty scary. So I think that's the kind of market reaction, risk off. So markets are now pricing in a higher probability of US recession, weaker global growth, weaker corporate earnings growth, because it's not just one company that's going to be affected by this. It's every company in the world, probably, to one degree or another. Not all will be negative. Some companies will benefit, but generally what happens when you have widespread tariffs is not that you necessarily favour domestic manufacturers. The problem isn't the fact that you get less imports from foreign countries, which may be a side effect, which will be a side effect. The problem is that you export less. And don't forget, there'll be counter tariffs now. We've already heard the European Union talk about what they're going to do. The UK isn't going to do anything. They've got off lightly with a 10% tariff, but the EU's going to retaliate, China's going to retaliate, and even countries that considered themselves to be allies, like Japan, have been heavily hit. Taiwan, shocking that they've been hit with this massive tariff. But again, it's difficult for some of these smaller countries to retaliate, but the larger ones are. So not only will we see the effect of tariffs on imports to the US, we'll see the effect of counter tariffs weakening exports for US companies. And just think about the tech companies. If it were the case that people said in Europe, well, okay, we're going to put a huge digital tax on services provided by US tech companies, well, that could be a huge problem for the US, given its concentration in just a few companies, for the US markets at least. So I think there are lots of potentially very bad outcomes that could result from this. So I think at the moment, all we're really seeing is a slight revaluation of the US, and it's not particularly cheap now. So we can have a quick look at the valuations just to confirm that. So let's have a look at some of the trackers. So let's have a look at valuations in the US right now. Yeah. So if we look at Schiller Cape, still pretty expensive. If we look at forward PE, again, quite expensive, although that has come down since this was updated. So if we go to, what could we use? There's multiple, isn't there? Multiple, Schiller. There we go, 35.32. So it's not the case that the US is now super cheap. It's not. It's still pricing in a huge amount of euphoria. And if we look at something like, let's get the Tesla valuation as of today. So if we look at the forward price to earnings multiple for Tesla, that's still trading at 100 times forward earnings, which is a huge multiple. If we look at the rest of the Magnificent Seven, their multiples are much more reasonable. So for example, Nvidia, we're looking at a forward price to earnings multiple of 25, but Tesla, still 100. And of course, it's been, on some days, it's been rallying. So it is pretty shocking that even now, the US is looking quite expensive. And there's still a lot of euphoria baked into US markets. And that in turn means that there isn't a support. There isn't a fundamental support for markets, and we could see a further sell-off, which would just take us back to fair value, remember. So it would just take some of the euphoria away, and we could see a 20% fall just to take us back to fair value, depending on what you define as fair value. So yeah, I think we could see further sell-offs. There's no sign that the US president is going to back down. If anything, he seems still fully committed to this, and he's doubled down on it. So if anything, this is just the beginning. So we're going to see weeks and weeks of these headlines, and it's not going to be good for markets. It's not going to be good for risk appetite. Kind of like his first term, when, if you remember, every time he tweeted about tariffs, markets sold off, and people were just thinking, oh, please don't do it again. Well, this time he's just kind of gone full tariff, and we can see the effect on markets. So not good, likely to stay bad, and possibly going to get worse is how I'd characterize it. What should you do about it? Well, I think the important thing is not to panic. Don't sell if equity markets fall. If you are still investing, remember you'll be investing at a lower price, so that boosts your long-term return. And I think it's best to always have that long-term mindset. What you're effectively doing is just buying at a sale price, look out for bargains, and if anything, buy more as markets sell off. If you're in retirement and you haven't de-risked already, again, if you sell now, you'll probably crystallize a loss. But the losses so far certainly are not that large if you've got an index fund. So let's look at something like VHVG, just to see how large it is. That's not stunned silence, that's just me looking at the price. Yeah, so it's down about 12%. Let me share that. Yeah, about 12% so far. And today there was another discontinuity at the open because of the sell-off in the US. So always consider the long term, right? So what we've seen is an incredible rally and then a little sell-off. That's the way to frame it mentally. Okay, it's 12%, but it's 12% from the all-time high. It's not 12% probably from the time that you've been buying. If you were really unlucky and you just won the lottery and you put it all in on the 18th of February, yeah, okay, well then you'll make a 12% loss. But for most of us, we've been investing for years and we've seen a huge rally and we've just seen some of the losses temporarily appear. And it's only a loss if you sell. So just remember that and just keep calm and carry on. Yeah. Okay, so I think at this point, let me turn it over to you and we'll ask some questions. There's a couple of things I'd like to mention. One of them is the video that we're going to be publishing this weekend. So we've got a video coming out which is talking about how you spend things in retirement. So is it better to sell your ISA first or your SIP first? So that's the one we're doing this weekend. And what we'll be using is a tool called My Finance Future. Now, for example, you could look at, okay, if there's a 10% sell-off in market, is that going to create a shortfall for my pension in retirement? How would you do that? Well, you need a cash flow modelling tool. Or you could say, given how much I've saved, will I have enough in retirement to pay for these things if this is my expenditure in retirement? Now, to answer those questions and to work out how much tax you'll pay and which is the most optimal way of structuring your withdrawals, I think you really do need one of these cash flow planning tools. So that's why we've collaborated with a company called My Finance Future. And if you're a premium member of our website, you get a 40% discount on My Finance Future. Let me just show you. Anyway, in the video, which I'm going to do this weekend, I actually show that for a fairly standard couple where I think the husband's got about 500,000 in his pension, 600,000 in his pension, they've got a couple of ISAs, about 100k in those, and they're looking for an expenditure which is the comfortable retirement definition, which is about 59,000 a year in expenditure. But you can actually make I think it's an £80,000 or more, £85,000 saving in tax by doing the right kind of tweaks of the withdrawal strategy. Now, you're not going to know what that optimal strategy is until you actually do the simulation. And in your circumstances, it would be different. But that's what we tried to answer in this video. So this is what the tool looks like. Let me just put it into full screen. So what you can do with the tool, these are the kind of cash flow projections. This is from age 55 to 100. And you can see what happens. This is pre-retirement. This is post-retirement. The individual cash flows are the actual cash flow payments. Now, anything which is above the yellow line here is a tax payment. So what you're trying to do is minimize these tax payments. And the green lines here are the state pension. And so what this can actually do is to show you what the future will look like roughly based on certain assumptions which you can vary. And the top panel is the not very optimized approach. The bottom panel is the slightly tweaked approach, which changes the order of withdrawal. So that's what gives you the saving. Notice how the cash flows now, the income payments, are below the kind of yellow line most of the time. So that's what gives you the 80,000 plus saving in tax. Anyway, watch our video at the weekend. I think you'll find it interesting. I certainly did. I was shocked by the size of the saving. It was incredible. So I think always with markets, it's always good to remember, what do you control? You can't control markets. What you can control is your behavior. Don't sell when markets fall. You can control the order of withdrawal in retirement. You can model it and optimize it so that it's optimal for you. But you can only do that with the right tools. So I think that's why we're excited to work with My Finance Future on this. Anyway, premium website members, if you're an annual member, you get a 40% discount from us. And also, if you're a monthly member and you've been a member for 3 months or more over the previous 12 months, you get the discount. So that's what we're planning. And also, do check out our podcast. So Michael and I, this week, we covered the £1 trillion question, is government debt out of control? So that is becoming more of an issue now as the US presumably is going to depend on tariff revenue to pay for the tax cuts which are also planned. So that's going to be an awkward moment, and it may cause the fiscal deficit to get larger. So it really depends on how large the revenue is from those tariffs, if there is going to be a big tax cut, a set of big tax cuts. Anyway, that's what I'd suggest you have a listen to, and that's our weekend video that's just about to come out. on Saturday. Brilliant. So do like and share, Laura tells me to say always. And do like and share, and let's answer some of your question. Okay, so we've got some super chats already. That's incredible. Thank you. So ENP, thank you for your super chat. They say, updated Scott Sederberg research, 33% domestic optimal. Okay. Yeah, so this paper that was by Scott Sederberg, we did a video in response to it. We talked about it on the podcast. There has been an update to it to answer some of the questions that were asked. And you're telling me that 33% domestic is optimal. I haven't actually looked at the updated paper, unfortunately. But I think one of the results of the paper was that 100% equity, the original paper was that 100% equity in retirement was actually one of the best strategies. I think what you're talking about here is something that's been discovered also by Tyler of portfolio charts, which is that if you look at the optimal withdrawal rates, the safe withdrawal rates globally, what you often find is that having a large slug of domestic stocks is actually quite helpful because they're linked to your economy. And if it is the case that you get domestic inflation, then domestic stocks are probably the best way to kind of overcome it. At least that's a theory, I think. I'm just thinking though, it probably depends on your country. You know, if your country is one that consistently underperforms or is a complete basket case, then I'm not sure that the domestic optimal strategy is going to be so good. But anyway, unfortunately, I haven't read that paper, the updated one. So I'm afraid I can't answer your question, ENP. But anyway, yeah, do listen to our podcast with Tyler and see if I can find it, because it was a really good episode and we really enjoyed talking to him. This is the one. So this is the one where we talked to Tyler, and it's called Building a Bulletproof Retirement Portfolio with Tyler from Portfolio Charts. And yeah, we had a great chat, and he talked about the domestic bias and how it can sometimes help. So back to your questions. The second super chat is from Gavin Lawrence. Thank you, Gavin. Do you hedge your portfolio at times like this? No. Very simple question answer. Now, I mean, I could do that with a kind of short ETF, you know, one that goes short an index fund or a US equity short fund, but I don't do that. I could just move out of risk assets, but of course that would mean selling some of my developed market equity tracker, and that's not something I've done. So from my point of view, you know, I just focus on the long-term benefits of being exposed to equity, and it's just part and parcel of that I'm going to have these short-term pullbacks, and they are short-term. If you really are going to be invested for the next 10 years or more, then you look back in 10 years' time, and a lot of these things which seem like the end of the world at the time just look like little blips on the graph. So that's the way to think of it, I think. Always anchor based on the future. Don't anchor on the most high price that you've had recently, the all-time high. Anchor on your average buying price, and you'll see that you've still got very good returns if you've been investing for, say, 5 years or more, or even 2 years or more in the current environment. So, you know, if you've had 2 years when the S&P has returned more than 20%, well, a 10% fall after that is not unexpected. In fact, almost every year there's a 10% pullback at some point. So that's the way to think about it. But personally, I don't hedge, no, because firstly, what you often see is when you get these big market sell-offs, you often get a very large rally that coincides with a very large negative falls. Now, if you sell at the first sign of trouble, then you get excluded from the big rallies. So you crystallize the loss, you're excluded from the rally, And when markets snap back, which they often do, you essentially are left locked in cash. You have to buy back at a higher price and you crystallize a loss. So that's why I never do that. I just stay invested and I just leave it. And I just find personally that's a much better approach. Now, if you find after this event, after this 12% global index sell-off, which is absolutely very common, if you find that that's really keeping you up at night, that tells me that you've got too much risk in your portfolio, that you should have not bought so much equity, because when markets are at an all-time high, that's the time to de-risk. It's not the point to do that now. So I'd say use this as a learning experience to learn about your risk appetite if it is really freaking you out. And maybe in future, when markets have recovered a bit and we're through this kind of patchy period and the volatile period, think about de-risking. Have a little bit less risk in your portfolio, maybe a lot less risk, based on not kind of getting back on. I think the problem was that we had huge rallies. People had FOMO. They took too much risk, assuming that things would be fine forever. Or maybe they even doubled down on the stuff which had done well, mega cap tech growth stocks, NASDAQ trackers, single Mag 7 stocks, all of that stuff which had done well, which has now brutally gone into reverse. I think that's the problem. People had piled into risk, taken too much risk, forgotten that things eventually correct, and that was the problem. So, take this as a learning experience. And I think hedges don't generally work, because if you do hedge, it often is quite expensive. If you go for put options, you have to pay the premium for the puts. If you go for de-risking into cash, there's cash drag. Cash underperforms stocks most of the time, usually on average by about 5% or more per year. So that's a big drag on your returns. So do I hedge? No. No, I don't. But look, not everyone has the same risk appetite as me. Not everyone has the same risk capacity or investment horizon. So just do what works for you. But don't sell after a market fall. That's a really bad thing to do. Particularly if it's a tiny one like we've got now. Next question. Paddy Magan. Thank you for the super chat, Paddy. He says, will the pound strengthen against the euro? Is FWRG a good hold for the long term? Also, is Teddy suffering a correction in his biltong allocation? Well, look, Teddy's never going to suffer a biltong correction. So, no, Teddy's fine. Teddy's quite happy. The pound and the euro, I think what's good about the pound at the moment is the one of the benefits of Brexit is that we're not going to be swept into the same group for tariffs as the EU. We probably wouldn't have been anyway. We're not considered part of the Eurozone. Would we have still had the tariffs if would we have had the tariffs if we were still part of the EU? Maybe. We certainly couldn't have negotiated trade deals individually with the US, which we now can. So maybe this is a Brexit dividend, and we should make the best of it. Ireland, on the other hand, is kind of caught between two camps because it's obviously part of the Eurozone, plus it depends on the US heavily for a lot of its revenue. And a lot of the huge tax benefits for US companies of being headquartered in Ireland, maybe that won't work anymore, and maybe Ireland is going to be particularly heavily hit by this. So I think that's the worry. So maybe, But anyway, this isn't about Ireland. This is about the Eurozone. Will the sterling strengthen versus the euro? I think it may well do, because of the fact that there's this kind of tariff differential. Normally what we think about is interest rate differentials driving currency. In this case, it may be a tariff differential which markets consider. But look, predicting FX is so difficult. I wouldn't try to do it. I mean, we could look at what's happened recently. Just look at FX majors. So sterling versus the euro share. There we go. Let's zoom in. So this is the number of euros per sterling. So in fact, what's happened recently is sterling's weakened versus the euro. So, so much for that theory. In fact, this is when Trump started talking, wasn't it? It was about, I don't know what time it's got here, but it was about 9 p.m. that Trump was talking. So that was about here. So there was very brief strengthening of sterling versus the euro, which rapidly reversed. And then over the course of today, and in fact since 10 a.m. Today, sterling is weakened, but not hugely. Let's look at the percentage change. Yeah, so 0.8%. And if we go back to sterling versus the dollar, you'll see the scope of that change is huge. Oh. Yeah, here we go. So there's that 2% weakening of the dollar versus sterling. So yeah, I don't think that I don't think it's obvious which way it's going to go, but I'd say that probably the UK will come out of this better than Europe when it comes to tariffs. Certainly has so far, about half the tariff so far. And remember that Trump likes the royal family, so he's got a royal visit coming up, and the Eurozone can't do that. They have several royal families, but Trump's mum loved the Queen, and so yeah, there is that in our favour. Anyway, yeah. Is FWRG a good hold for the long term? Yes. It's a global fund, low fee, and global equity performs well long term. Okay, it's got a big US allocation, but any global index fund does. So I'm not convinced that the US is going to I don't think it's going to be a catastrophic outcome for the US. I think what's quite likely to happen from this point onwards is things will go south in terms of economic data in the US. I doubt there'll be a full recession. I think there'll be a weakening of growth. I think probably US exports will fall quite dramatically. I think the counter tariffs will be quite severe. I think heads will fall within the administration. The grubby finger of blame will be pointed at various people. Lutnick, I think, currently is in the line of fire. And then they'll change the policy. They'll certainly have to back off once the full economic effects start to be felt. I think if they carry on with this regime for 4 years with the tariffs the size they are, that would be hugely problematic for the US economy. So I think it's unlikely to happen and hugely unpopular with the US people. Remember, the reason why people voted for Trump was they didn't think that inflation was low enough. They thought inflation was too high, and they wanted manufacturing jobs back. But I think the pain that they're going to have to suffer to get there, if they use this tool to get there, then it's just going to be too painful. And there'll be too much loss of growth temporarily, maybe not temporarily, and people just are not going to put up with it. Anyway, there we go. Next question is from the Yidman, who says, what do you think about the dollar for next month? Why is it falling? Versus my currency, Noki, Norwegian Krone, has weakened about 10% this year. S&P 500 is down 14%, and dollar is down about 10%, starting to hurt. Smiley face. Okay. So yeah, I think it's shocking that the dollar's weakened when people are scared. I think that's really unusual. We haven't seen that in the past. When you have risk off, usually it protects UK investors and other investors across the world, which is that when people are scared, if you're a risky currency, then your currency sells off, your US holdings increase in value, so your sell-off of US stocks is smaller than people who have to live through it in US dollars. So for Americans in 2022, the tech wreck was terrible. In sterling, it wasn't so bad because sterling weakened versus the dollar and it reduced the size of the fall. This time around, what we're seeing is the opposite. So sterling's strengthening versus the dollar at the same time as we've had the risk-off move. And that's not been great for UK investors. Now the Noki, let's have a look at the Krone just to have I got Noki? No, I don't. How has it not got Norwegian Krone? It's got it versus the euro. We got USD. Yes, we do. Sorry, I don't know why I didn't find that. Yeah, so here we go. Now, obviously, Norway exports a lot of fossil fuels. There's exposure to the oil price. And as we can see, it has been a fairly brutal fall. So the Noki has strengthened versus the dollar. Oh wow, 8.2%. Wow. Okay. Now let's have a look at the oil price, which is also interesting and I suspect related to this. Oil. What we have seen over the last day or so is a big fall in the price of oil. Not huge, but reasonable. So 6.4 for Brent. Yeah, 6.4 for Brent. And let's get WTI, West Texas Intermediate. Again, a sharp fall. Let's just quantify it. Yeah, about 6.8. So clearly, you know, that's not going to be good for the Norwegian Krone. So if you have got a kind of commodity currency like the Norwegian Krone, then yeah, your currency is probably suffered a bit, but I guess the question is, let me just get your question. One sec. My currency, the Nokia, is weakened about 10% this year. S&P's down 14, dollar down about 10, starting to hurt. Yeah. So, yeah, I think that's what's shocking about this, which is the kind of currency effect, the fact that the dollar has weakened. But is that going to continue? I don't know. I'm not convinced that it is going to continue. I think probably this is just the initial shock reaction. Maybe later on people will start to calm down a bit and the dollar will become a safe haven again. I think that's quite likely. We'll just have to see what the economic effects are, what the fallout is of this huge economic move on the part of the Trump administration. So if the economy does get much worse, if it is clearly a catastrophic decision, which they're not willing to backpedal on, then yeah, the dollar weakness will continue. I'd say that it's not going to be that bad. I'd say that initially we'll get a weakening of data, we'll have a period of weak economic growth. I think the counter tariffs will be painful, but again, it'll hurt in certain sectors more than others. The good thing is that the US economy was so strong going into this, so they've got a bit of leeway and they can probably avoid a full recession. But maybe this will just be an initial negotiating tactic and then hoping that other countries will buckle and that the tariffs can be dialed down. At least, let's just hope that's the plan. But yeah, I mean, this is, I guess, one case for investing in domestic companies. In Norway, I guess you're fairly limited in terms of what you can invest into. Maybe choose currencies which are less volatile than the dollar. I never thought I'd say that. You know, for example, Europe or Japan, you know, that might be the alternative to tilt away from the US if you are worried about your currency exposure and there's been such a huge move in the NOK. Next question is from Alp Marangoz, which is a super chat. Thank you. They say, previously when markets crashed, gold also crashed. Is this a common thing? Is there an indicator about how other asset classes can be affected? Yeah, I mean, gold actually holds up pretty well in most risk-off moves. So if it is the case that gold is a safe haven, which many people think of it as a safe haven, let's have a look at it in this sell-off. And I think it's rallied hugely this time around. Certainly, yeah. So this is the value of gold recently. So let's zoom in. So this is gold over the last 2 days, 3 days. So the Trump speech was about here. Gold rallied a bit into the close, and then it tanked, and then so it's certainly been very volatile. But usually gold holds up pretty well. So if we go back to 2008 and look what happened to the price of gold, you can see that it actually rallied quite significantly. So 2008 worked. The one where it didn't work very well was the sell-off in 2020 with the COVID sell-off. So you can probably see the COVID sell-off here. So gold fell alongside risk assets, which was kind of shocking and unusual, it has to be said. So usually gold holds up pretty well with very sharp equity market sell-offs, and it's held up this time. You know, it hasn't fallen anywhere near as much as equity. So is it still useful as a safe haven asset? Yeah, I think it is. That's why it's useful to have gold, because it isn't correlated with equity. It just does its own thing, and if people are scared, they tend to buy gold. So that's why I think it is useful. However, in some cases, what's kind of weird is gold crashes when equity doesn't. So it has its own crashes, which you don't really want in a hedge, which is why I've always disliked it as a hedge. But a lot of back tests show that having some gold, actually quite a lot of gold, about a fifth of the portfolio in gold, historically has actually been quite helpful in these really extreme market moves, which do occasionally happen, just to smooth out the returns of the portfolio. And so if you are withdrawing from the portfolio, I think having gold there is quite useful. If you're accumulating, usually gold's return isn't as good as it is for, say, equity. So I'd say doing accumulation, I think it's harder to make the case while you're saving to have much gold there. But in retirement, I think having some gold, simulations show that is actually a useful thing to have as part of your portfolio. Again, have a listen to that Tyler podcast, because we talked about it there a lot and the reasons why it helps. Next question, SJ. Why can't highly intelligent people beat the market? I think one of the problems is how quickly markets price in information. And I think if you had insider information, sure, you could price that in and beat the market. But everyone has the same information. If that weren't true, they'd go to prison because it's illegal to have insider information. So if everyone has the same information and we all have ChatGPT, so even that kind of levels up the intellectual scores as well. You don't have to be super intelligent to do research, to work out basic market reactions to macroeconomic data. You can just ask ChatGPT. It is difficult to have an edge. So I think in order to beat the market consistently, what kind of edge would you have? I think it's actually very difficult to have an edge in these markets. And just being intelligent is not going to cut it. There's no way you're going to see some kind of pattern which no one else does, because there's not really that much that you could kind of work out from first principles. You've got there's no way you can forecast profits or know what's going to happen to a company's profits in the future with any degree of certainty. And that's what you need to do. So I think that's the fundamental problem. And there isn't some kind of, inference way of doing that by looking at all the factors in the world and just working out this company's profit is going to be X, Y, and Z in the next 3 years. That's just impossible. There are just too many variables to do it with any degree of certainty. So I think that's one of the reasons. The markets are efficient. The market is so well studied that if there is some kind of edge or if there is some kind of information about a company which suggests it's going to outperform, people are going to pounce on that at the same time. So that gets rid of the alpha because markets are efficient. So that's really the problem. Nobody has an edge, I don't think. And I was always shocked by this when I left investment banking, that there isn't an ability to just be clever and beat the market. Because it was never said explicitly, but we just assumed that if someone's a good fund manager, they can beat the market. But when you actually look at the data from S&P, the SPIVA report, the numbers are just brutal. It's very difficult to beat the market net of fees. There is a little bit of outperformance you can generate, but that's usually gobbled up by the fees. So if the fee structures were more reasonable, then maybe you could outperform a bit, but not consistently and not in scale for over the long term. It is a very robust result. Next question is from Amir Ketobchi, who says, "Hi Amir, nice to hear from you. Super chat. The new tax year starts next week. If you had 20k poised to invest at the world, would you pile in or wait for the Trump madness to get worse? And if yes, where would you put it?" Well, look, if it's my core, I just buy my core equity fund, and I'm now buying it. I would have bought it at the peak. Now I'm buying it at a 12% discount. So that's the way I see it. Normally, there's no benefit to delaying. 2/3 of the time, if you put the money straight in, you outperform drip feeding over a year. And this is a result of research by Vanguard in Australia, the UK, and I think the third place was the US. So they did 3 different countries and came up with a very similar result, which is 2/3 of the time you're better off lump sum investing. So that's probably what I'd do, particularly now that markets are cheaper. They're still not cheap, I have to say, but they're cheaper than they were. Now, I find myself in this situation because, I have moved to SIP in cash. So for me, it is quite scary fully allocating that cash straight away. So, if it is a large sum of money, then if you are of a nervous disposition, which I am, and my SIP is significantly more than 20k, I have to say. So for me, I am scared to commit all that capital straight away. So I probably will drip feed that. I haven't fully decided yet. But at the moment it's sitting in a money market fund. And I probably will drip feed, I'm not sure, but I think I probably will. Because for me it is scary, given the size of the investment, given the volatility of markets. But just remember why you're drip feeding. It's to enable you to do the right thing, which is to take that leap into risky assets. It's not necessarily economically better, it's psychologically better. So it's a way of psychologically overcoming that hurdle of taking your hard-earned money and putting it at risk in equity markets and subject to this volatility. What's weird is once I'm fully invested, I don't worry. I'm just happy to leave it there and I don't really think about it much. The actual process of investing it is the difficult part, in my experience. And the way I overcome that fear, the way I did it in the past as well, was to drip feed. In the past I drip fed over a 2-year period. This time I'd do it more quickly because I think that was excessive. And markets didn't sell off during that period. The tech wreck happened right at the end and I accelerated a tiny bit, I think, towards the end, but it made hardly any difference. But it was just a huge pain, to have to do it every month. and do it for a long period of time and be consistent. So I think there's a strong argument to be made to put it in straight away. And if it was just 20k, I probably would put it straight away in my one fund. Charles Gibbons, Super Chat, thank you. I have a workplace pension in Scottish Widows. The only global fund I can use is Scottish Widows Global CS8. Ooh, fee is 0.55%. That is worrying. Let me just pull that one up. Scottish Widows Global. I don't know what the CS8 thing is. I mean, that might just be for your fund, for your platform. It may not be a widely available platform. But look, if that's what you've got available to you, so be it. You know, you've just got to live with what you've got. But certainly what some of the pension crafters do is they take their workplace pension, if it's a defined contribution one, and every year they transfer it out to their SIP. Now, there are certain things you have to check. Are you giving up any benefits when you do that? Are there any kind of insurance products linked with it, for example? In which case you might have to think twice about doing it. You may not want to do it. But if there aren't any kind of other benefits, if it does give you more choice, lower fees, then it's certainly worth considering. And it is pretty easy to do that transfer. Again, another video which is in the pipeline is me transferring my SIP. So you'll see it's not that difficult to do. There are some forms you have to fill in. You have to be aware of the risks. You have to be aware of the drawbacks. And you have to manage it. You know, not everyone's comfortable with that. But, you know, I was quite comfortable to do it. But that is one option if you have considered that, Charles. The other option is you have a say. There's usually a pension committee at your workplace which has the ear of management, where they decide how to invest the money, and they have representatives from the staff on that committee. So just find out who that is in your organisation and just say to them, look, our choice is dreadful, our fees are high, and it won't cost the company much more money or any money to have another platform as a cheaper platform with wider choice as an alternative, or instead of what we've got already. So it's not as if you haven't got a voice at all, Charles. You could probably do that in your workplace. Next question is from Visual Ghoul, interesting icon, who says, Super Chat, how do you do puts in the UK? Firstly, I'd say don't, because puts are expensive. There are platforms where you can buy derivatives in the UK, but if you haven't used derivatives before, remember that it is just like an insurance policy. You have to pay a premium for it, cash up front, and they come with an expiry date. So let's say you buy a 3-month put option on the FTSE or the S&P 500. Okay, that'll protect you for the 3 months, but then when it expires, you have to buy a new one. And if it's a period of high volatility, the premium goes up. And that's the kind of really annoying thing. When volatility is high, options cost more. So there's no free lunch here. And that put premium will eat away at your long-term return. And that's why most of the time it's not worth having the protection in place. By the time markets have sold off, volatility's picked up, the puts will be really expensive, and probably by the time that the protection is going to be worth anything, markets may have snapped back, and you'll be left with a worthless put, which you paid a high premium for, and that's the problem. And if you buy puts all the time in case there's a sell-off, well, unless it's hugely away from where the market's at, when it becomes cheaper, if the strike is well below the market, it becomes cheaper, but it's less likely to give you much protection then. You know, there is no kind of easy way of avoiding losses. The best way is to just ride through it, if you possibly can. And if it is money you're not going to touch for a decade or more, who cares? You know, it's not going to really affect you materially. It's very likely markets will have recovered in 10 years' time. and probably, very likely, much quicker than that. So what I would say is, firstly, don't buy them. If you are going to do it, make sure you've researched it and make sure you understand options inside out if you are going to buy them. Because what you could well do is buy the wrong size of put, buy the wrong strike. There are lots of things that can go wrong. But anyway, there are platforms where you can buy puts in the UK. Not inside an ISA or a SIP, it has to be said, usually. So that's the problem. Next question is from Lewis Porter, who says, we're getting close to the end, ticker PSRF, good hold with a global tracker. I guess you mean alongside a global tracker. PSRF. Power shares, FTSE. Oh, this is one of the RAFI funds. Okay. So look at this one. So here it is. The ongoing charge, 0.39. So it better be special. 0.2% is usually the most I pay for a fund. And what does it do? What does it do? Yeah, so it's the FTSE RAFI US. So these are one of the, I think they're the fundamentally weighted indices. What does that mean? Well, instead of market cap weighting, these things weight based on some kind of fundamental measures of value for the stocks inside the index. So let's see what that is. Blah, 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 blah. Index constituents are weighted using a composite of fundamental factors, including cash dividends, free cash flow, total sales, and book equity value. So there's a combination of value measures. Dividends, again, another measure of value. Free cash flow, or if it's price to cash flow, that would be another measure of value. So it sounds like it's a value index, but I can't be sure of that. And if we look at the top 10, you can see it's not the usual top 10, although Apple is there. It's not the Mag 7. It's got banks, it's got oil, it's got Chevron, and a healthcare provider, which is unusual to see. So it's still got a fair old slug of tech in it, but not as much as FTSE USA All Cap, which is 32. So it's 13 versus 32. So it does look like it's a kind of value tilt to me, although I'm not sure of that. But would I hold it alongside my global equity fund? Well, if you believe in value, yeah. But the problem always, if it is a value index, is that value has underperformed now for about 20 years. It has had a bit of a time in the limelight recently, but it has underperformed for a long period of time. So that's always the problem, sticking with these fundamentally weighted funds when they underperform, which they inevitably do. So I'd say some combination of factors is probably better. Value and momentum is a good combo, because then you don't have to wait around for things to improve. They've already started to improve and it's still cheap. So that might be a better thing for the impatient. And we're all impatient when it comes to these strategies. You know, waiting 5 years for something to turn around because you believe it will is too much to ask, I think, of most people. But would I hold it? Probably not. Not a kind of single factor value fund. Quality, I think, is another good one. But I think these combinations of factors are probably better, and usually having some momentum in there is good, because you don't have to wait for things to happen. 2 more questions. One of them's from Endless Spaghetti in Swissies, who says, where would you recommend I move my Swiss franc savings? Why would you move them? You know, I think the Swiss franc's pretty good, but, you know, big tariffs for Switzerland. I think it was 30% from memory. But why would you want to move? I'm not sure why you want to move them. But usually the choice of currency isn't something which is arbitrary. It's the currency you live in and breathe and spend in. So usually it's best to keep it in whatever currency you're going to spend it, because there's no currency risk. Why add additional risk when you don't need to? Plus, Switzerland's a lovely place. I love Switzerland. So I'd say, it's probably better to keep it in the currency where you're going to spend it and where you're going to live. It's a bit more complicated if you live in more than one country. I sometimes speak to people who live in 3 countries, 4 countries. So for them, it's much more difficult. And they haven't decided where they're going to retire to or where they're going to live or how much time they're going to spend in each country. So for them, it's much more complex to decide the best currency. But usually you don't have to decide. If you spend some time in New York, some time in London, then you'd have currency in both of those countries. So I'd say, keep it where you spend it. And don't introduce currency risk when you don't need to. You can still invest in equity. There are some good Swiss brokers which are reasonably priced. So I'd say just keep it in Swissies. But that's not advice, of course. But when it comes to currency, who knows, right? Currency, so difficult to forecast. But the Swiss franc, yeah, it's a good currency to have. Finally, last question, and we're 2 minutes over. The Sub-Zero77 says, hi Ramin, isn't the issue with only index fund investments that sometimes markets simply do not recover very quickly? S&P 500 adjusted for inflation took 15 years. I make it 12.7 after the 2000 crash. Yeah, it can take time, but this is why I'm saying if you're accumulating, still investing, then for that whole 12-year period, 15-year period potentially, you'd have been buying at discounted prices. So if you need the money within the next 10 years, this might be an issue, this sell-off. If you don't, all it means is you're buying at a discounted price, and that increases your long-term return when markets snap back. And they always snap back. They always have in the past. It would take something truly catastrophic for a global index to sell off and not to recover for 15 years. It's never happened. There's never been a case where, certainly for US markets, that they've fallen over a 20-year period. That's never happened to my knowledge. So things eventually recover. And this is why I always say the investment horizon is important when you're investing in equity. If it is for a decade or longer, it's almost certainly going to give you a positive real return. That's the way to think of it. So if you're in the accumulation phase, I'd say, yeah, don't worry about this. This is actually a benefit because you're buying more cheaply. And it will recover. It always does. And this is a tiny sell-off, tiny, in the grand scheme of things. 50% sell-offs, that would be painful. But this is just a wobble, a correction. So I wouldn't panic at this point. And I wouldn't panic at all because things will eventually improve. So that's it. Thank you all for joining us. Don't forget to like and subscribe. Don't forget to listen to our podcast episode, which is Building a Bulletproof Portfolio. Oh no, that wasn't the one. It was the one about debt. Yeah, it's the £1 trillion question. Is government debt out of control? And don't forget My Finance Future. We've just offered that to our premium members. So if you're an annual member, you get a 40% discount on that. For UK members only, because it's a UK cash flow planning tool, but you get a 40% discount. It's reasonably priced, and you can produce your own financial plan, which is very useful. And you can tweak your tax. And if you're the kind of person that loves spreadsheets, you will love My Finance Future. There are endless whistles and bells that you can adjust. So thank you for joining us. Don't panic. Everything's going to be fine. And don't sell if markets have fallen. So thank you for joining us, and we'll speak again soon.